Thank you very much. Welcome back. Chuck Malamut is here. For over 25 years, he has been the official financial advisor to the Hurley in the Morning program. The program that you're about to be blessed to listen to is a program presented by Chuck Malamut, a financial advisor at Morgan Stanley. The information, views, and opinions expressed on this program are those of Chuck, do not necessarily reflect those of Morgan Stanley or its affiliates. They are current as of the date of today's broadcast, subject to change without notice. Neither the information provided nor any opinion expressed herein constitutes a solicitation for the purchase or sale of any security. This presentation is for informational purposes only. Morgan Stanley, Smith Barney, member SIPC. Well. We meet again, Mr. Malamut. How are you?
Good morning, Harry.
Good to see you.
How are you today?
Good. Real good. It's been a great morning.
Certainly a riveting couple hours, no doubt about it. So,
and now you're here.
Hard.
It's all good.
No, I was thinking the same thing. That's all right, Harry. It's not a problem.
Hey, Chuck, we love you. Your audience adores you. You're my brother. And give us your market update. Time is yours.
So, Harry, last week we actually had our second consecutive up week. Hard to believe, certainly. The lows that we put in.
It's a Donald Trump rally. I'm sorry.
No politics.
Take that back.
Politics.
Take that back.
Although I do know who you. We do know the results, I guess, in advance of tonight, but we'll kind of leave it aside.
Thank you.
In just a few weeks, the markets seem to have bottom on that, and that date was February 11th. We had, just awful sentiment, tightening financial conditions, a lot of anxiety surrounding a global recession, and then that discussion about negative interest rates to be potentially looked at back in 2010, but then again here in the U.S. Now that is fallen by the wayside, so that is not in the cards. The other question was, you kind of fast forward it and you look over the last 2 weeks, and we put in positive returns. February as a month was down, ever so slightly, and but as we open up here, the beginning of March, we seem to be tracking fairly well. So, that's certainly on a positive note. Now, Harry, I'm not quite certain if we can give the all clear signal at this point in time. But what is happening that over the past few weeks we've gone a really long way in validating, our thought process that we should get decent returns here in the U.S. The market's behavior at this point in time, Harry, is pretty indicative of what we want to describe as a late cycle environment. We still believe at this point in time that the U.S. is going to avoid a recession. One of the things that we had chatted about early on in this year was not only did we think that there would be decent growth in the U.S., but we would also see it, in Japan and in Europe. That hasn't materialized as yet, but the recent resilience lately that we've seen and the rally off of the lows earlier this month is something that we think to continue as long as economic data remains constructive. So, that's kind of in a nutshell where we think we are at this point in time.
Well, good. I did notice that gasoline. I use my corner store as sort of not a empirical statistic, but just sort of anecdotal. It went all the way down to 141.9 for a regular gallon of gasoline. I thought that was extraordinary. Now, in the past 2 days, it's up to 149, 8 cents in 2 days.
Well, Harry, we've seen a pretty good rally of late within the oil markets, and particularly as we got into last week. And the fact of the matter is, oil still, or the market still trades in conjunction with oil. That you have that 90% correlation. We need to get away from that, and hopefully we will break away fairly soon, because traditionally you traded a 50% correlation, not in a 90% correlation. So, while the market has, been able to, recover somewhat, because it's acting in concert with oil, I still believe, and we still believe, that we need to break away from that.
Brief time out. We're going to be right back 11 minutes past the hour. You're listening to Chuck Malamut, the official financial advisor to the Hurley in the Morning program for all of your financial planning needs. Turn to Chuck and his great team, the Malamut Group at Morgan Stanley's Northfield office, and you will learn how and why and become a part of the story where Chuck has perfected his concept of total asset management coupled with the all-important asset allocation. 609-383-2010. 609-383-2010. This portion of Hurley in the Morning also brought to us by your New Jersey Assemblyman Chris Brown of the 2nd Legislative District. We'll be back with Chuck Malamut in just a moment. Stay with us. And this portion of Hurley in the Morning brought to us in part by the exclusive country club for the Hurley in the Morning program, Harbor Pines Golf Club, located at 500 St. Andrews Drive in Egg Harbor Township, owned by the legendary Gerwicks family. You'll thoroughly enjoy working with the great team there. General Manager Alan Greenman, Director of Sales and Marketing Debbie Stevenson. They have a wonderful team. They're great to work with directly, and they have a wonderful team beneath them. Their overall service and attention to detail and follow-up systems are excellent. They stand for quality of product and service, and the quality of the human resource level coupled with the quality of the physical plant, the reasons why we chose the Harbor Pines Golf Club. Remember, when I talk about our various presenting clients, I am typically their client in almost every case, and no exception here. The 9th Annual Hurley in the Morning Golf Open will be taking place at Harbor Pines. 8 a.m. is the breakfast hour and registration hour. 9 a.m. shotgun start. We're going to have an incredible charity silent auction, a wonderful, wonderful event, and then everyone will come back from the golf at around 1:30, 2 o'clock-ish, and we'll have a great lunch together, quick awards, and we try to get everybody out of there by 3 o'clock at the latest so that you can enjoy the rest of the day. The former Assemblyman Ed Klein was the one that suggested that we were going back and forth, hey, what time should it be? And Ed Klein said, Harry, he goes, you're Hurley in the morning. You're a morning guy. It's a morning event. And it has served us so well. It works out great. We become the nerve center of the metro market where all kinds of people stop by, members of Congress, members of the Senate, of the Assembly, community leaders, and all kinds of great people that come out, and you can be a part of it as well. I will say this, if you want to enter a foursome, I haven't even started to publicize it yet. You better email me quick. I am shocked at how many people have already pre-registered for something that's not even taking place for many, many months in the future. Harry Hurley at AOL.com, or certainly any day of the week, you can catch me here. So as I always say, I don't ask you to do what I would consider doing or something I might do. I ask you to do what I've already done, and that is choose Harbor Pines Golf Club, make them your official and exclusive country club. They have great rates and very flexible times so that it can work best in your situation, and they also have a number of different memberships that work out very, very well. Full membership, limited, twilight, associate level, all happening at Harbor Pines Golf Club. One last favor, tell them that I sent you Hurley in the Morning. Chuck Malamut, time is yours.
You know, Harry, oftentimes we talk about the importance of asset allocation. And once again, that strategy has proven out to be one that's been fairly successful. So let me kind of roll the clock back here. Think about when we turned the page on January, and the market tone was just absolutely awful. And if you remember, and we still have it today, so it's something something we all think about. You know, the word volatility, the VIX index, as is referred to, continue to move onward and upward, and which signified higher volatility. But, the market, Harry, had a lot to think about and a lot to digest. We've chatted about what has been happening in manufacturing and the fact that, a lot of jobs, that were created here in the U.S. have either disappeared or have gone overseas. Right before the break, you were chatting about oil, and we can get to that in a second. But we've had certainly an oversupply, a glut, and then earnings as we know them, while they were relatively good, and they were because they were measured up against the beaten down consensus estimates from various analysts. So, Harry, as we got into this weekend, if you think about it, we've now been in, so now we've traded, or not traded, we've had 60 days, January and February. Roughly, 5 of the 7 days of the week we trade, so we'll say 2/3, 3/4 of those days we've traded. Let me throw it out there. What do you think? And I did not give you the answer in advance. How many days during the months of January and February do you think the S&P had movements of in excess of 1%, either up or down?
Ooh. All right, the internal bias I have just from doing your show and following things the way that I do, that I would think that would be a substantial number. There's 31 days in January. Did you say January, February, right?
January, February, yeah.
So there's 31 days in January, and there was an extra day in February, 29 days in February. Not all are trading days, of course. Let's just say like a little over 20 and 20 of trading days. I'm going to say, I want to say the perception is that the number would be the vast majority of it. So I'm going to play I think I'm going to be wrong. I'm going to play the fool's game. And I'm going to say, let's see, if there were 40 possible times that it could happen, I'm going to say 30 times.
You overstated slightly, but actually 23 days.
Wow.
I was
going to say 20.
That we traded with movements in excess of 1%, either higher or lower.
You would call that volatile?
So that means, you think about it, 3 days a week. Mm-hmm. For the months of January and February, we traded with that sort of volatility. So, so the importance of diversification is clearly out there and is very, very significant. It's identified in the fact that let me ask you another question. Let's take a portfolio that is now diversified, 60% equities, and the equities that we'll use is the S&P 500, and 40% fixed income, and we'll use the Barclays Ag, which is pretty much intermediate term, corporates that we use. How many times do you think we would have moves in excess of 1%, high or low, over that same time period?
And I can break these two things. I can say equities, what percentage? And
no.
So it's the breakdown. I'm counting one portfolio broken down
instead of having 100%.
Right. So the 40% can affect the 60. The 60 can affect the 40. It can affect the 40. I'm going to play the game again and say it's in that same range. I'm going to say 25.
No. A balanced portfolio of less equities and more fixed income.
You said 60% equities, 40% fixed assets.
So what happened was the first item we chat about, 100% equities, 23 days and volatility of excess of 1%. With a balanced portfolio,
it would be very low.
It goes down to 6 days.
Sure. Yeah.
So what happened was...
That's why we talk about for 25, 26 years the importance of total asset management coupled with asset allocation.
Yeah, so the year-to-date return in that balanced account through the end of the month, through the end of February, Harry, would have been about less than -2%, minus 1.9. And everybody knows what happened with equity markets across the world, where you are averaging returns anywhere from -4% to -9%.
Chuck, quick time out. We're coming back in 2 minutes. Don't go away. You are listening to the official financial advisor to the Hurley in the Morning program. We're in our 26th year together here in the 8 o'clock hour on Tuesday. That has never changed in all this time. Chuck Malamut leads the Malamut Group at Morgan Stanley's Northfield office, 609-383-2010. And again, I always make it a point, as I did 10, 15 minutes ago when I mentioned that, turn to Chuck, tell him I sent you, and you'll be impressed with his commitment to total asset management coupled with the all-important asset allocation.
Glenn Beck is coming up at 10 this morning. Then Michelle Dawn Mooney at 1. Now, Harry Hurley on WPG Talk Radio 1450. South Jersey's talk station.
Hey, thanks very much. Welcome back with Chuck Malamut. It's early in the morning. This is our weekly program all about your financial matters with the official financial advisor early in the morning, Chuck Malamut. He leads his group at Morgan Stanley's Northfield office. The Malamut Group, easy to get in contact with. Call Chuck and his team at 609-383-2010 for all of your financial planning needs. Chuck, awesome piece of information there. It really illustrates not only what you've been saying on your show for over a quarter of a century, but how absolutely, it is Captain Obvious to an extent, but how absolutely significant asset allocation is, because look at the difference between the two objective statements that you discussed on your show, showing 23, wild swings of more than 1%, but so few if you have proper asset allocation. Yeah,
Harry, and I think it all goes back to having a plan in place, and if the plan is in place to have the proper asset allocation, and at the same time to clearly understand, why, you're putting money to work, and what is the overall purpose, and without a plan, it's like driving in your vehicle. We talk about it all the time. It's like driving your vehicle without a GPS, where the GPS just continually puts you round and round and round and going in the wrong direction.
Chuck, you look very young today. I'm looking at Chuck Malamut. He looks
no,
so young
I don't think so, Harry. I think
very young.
I think age is really starting to show itself. So, before the first break, we kind of chatted about oil, and I think your comment was that you were filling up and gas prices, were continuing to escalate. All
of a sudden, they were coming down a couple cents. It seemed like every day. I don't use the regular, as you know, I use the premium, but it got down as low as 141. I know that at Kirk Conover's home gas station, it went into the 130s, maybe even low 130s. But in the last few days, it's gone up about 8 cents. Any cause and effect for that?
Well, Harry, I think if you take a look, there's somewhat of a correlation still. If you take a look at the price of West Texas crude, year to date, as we got to, year over year, February 15th through February 16th, the price of WTI was down about 45%. The price of gasoline at the pump was close. It was down about 34% over that same time period. And I think it doesn't take much to figure out once the price of oil moves higher, and it has over the past 2 weeks, it has almost an immediate impact at the pump.
Are people taking into effect the proliferation of natural gas? There is a boom right now with natural gas. Not only can vehicles run on it, but obviously instead of using heating oil, natural gas is cleaner. It can be more economical. Is natural gas part of the reason that oil is having some of the contraction it's having?
Well, if you take a look at the price of natural gas, actually that is down almost 50%.
Okay, so
over that same time period. So I think it's a matter of the markets adjusting to the glut of oil that is out there. We sit and we watch and we wait for reports to come, from the Saudis. Are they in? Are they out? Are they going to, put more oil onto the market? Or are they going to reduce? And you see those volatile movements in oil as a result, oftentimes, of just the news that comes. And I think we need to have certainly this decoupling of trading with oil. I mean, certainly investors are very, very happy when oil goes up and equities move higher. Conversely, the opposite is happening as well with oil. With the price of oil declining, the markets go hand in hand, and we need to break away from that, and we will. Markets, if you look at volatility, it typically takes about 30 days from top to bottom with this excessive volatility. I
do notice with oil, though, it moves up much quicker than it moves down. And I don't think that's just, perception. That seems like that's the way they do it. They can really jack it up quick.
Oil or the price of gas?
Oil. The price of gas.
Okay.
Price of gas.
Well, yeah, that is I think, a little more controlled.
But I think, for example, anything that's in the tank, I think there should be regulations. The state roads, for example, can only change the price once a week. I'm convinced that people can change the price several times in the course of a day.
But it has happened.
And it can be the same oil that they paid a certain price for, and they're jacking it up for some future, type of consideration. Chuck, we're at a hard break. When we come back, I want to get your take. For the first time in the history of the Republic, 240-plus years, we have 10 years of not growing 3% GDP or better. We have been 2% or less. The fans of failure are having, they're in their glory because fourth quarter GDP was revised upwards from fractional growth 0.7 to whoop-de-doo, a full 1 percentage point. I want to get your take. Is that really what it's come to, Chuck? Are we celebrating 1% growth in America? Please give us a great answer when we come back.
At the Jersey Shore on 1450 AM. Across all of South Jersey at 104.9 FM, HD2. And everywhere on your cell phone at WPG1450.com. This is Hurley in the Morning on WPG Talk Radio 1450.
All right, this is the point of the program where we get to celebrate 1% growth for the fourth quarter in America. Let's hear it for 1% growth, GDP, baby.
Well, Harry, I think you got to really clearly understand what that revision was all about. We go from 0.7 to 1% as previously reported, and you're. Come on. I think you're going to probably run me out of the building.
No, say it with a straight face.
No, much of the improvement actually was a result of stronger build in inventories, which helps explain why manufacturing has been so weak so far this year. So in reality, you think about, is 1% really 1%?
Exactly.
Or is it more like that 0.7 and the number got moved because of mitigating factors that has nothing to do?
I will go with the latter and not the former.
Yeah.
Thank you.
So, here's where we are, Harry. I mean, you look at the markets, and
by the way, do you have any comment of 10 years? We talked about
because
years ago on your program. We talked about the lost decade in Japan. They literally lost a decade. We've lost a decade.
We've lost close to a decade, and a lot of it's still going to be blamed on the Great Recession.
Okay. But even the Great Depression had multiple years of beyond 3% GDP.
No, it's
so. What's the? And we had people in soup lines and in cardboard cities and shanties. So there's something extremely wrong here.
Look, we need to certainly break away from where we are. There's no doubt about it. And not to go political, but I think as we approach November, it's going to be that much more important than it has been previously that we put the right people in charge of our country.
You realize unemployment might be zero by then.
Well,
got a good chance.
We're
100% employment.
Well, we're 4.5 to 5 right now, and
we're on our way.
Harry, I sense just a fair amount of sarcasm as you're throwing the H bombs out.
I'm saying 100% employment is our goal. For November 8th.
In any economy, I think to get to we are theoretically, statistically, and there's a lot of ways to spin the number.
We're statistically 1.5% above full employment right now.
So we are effectively. So how do you get full employment and a GDP number that's less than 3? It just
make it up.
You get that fuzzy.
That's how you
get that fuzzy math.
That's right. You make it up.
So as we ramp to the end of the year, I think a lot is going to be put in the hands of those folks that are in charge of our country. But I still think, having said all that we're not in. You paint it to be that we're in a really, really bad place. I think we're okay, but we need a lot of improvement.
Here's what I really believe. Thank goodness in all of this insanity of the past 7 going on 8 years now that the financial sector has found its way through what I think is an incredible labyrinth of challenges and really, really just systematic failures of government to really keep us going. That's a compliment.
Yeah, I don't know if we're totally through that. I think domestically here in the U.S., we've done a much better job in regulation of the financial institutions. But as evidenced in what happened, particularly in Europe a couple of weeks ago, with a lot of banks, and I'll throw a name out there because it's I'm not saying anything I shouldn't be saying, but Deutsche Telekom or Deutsche Bank. I'm sorry, literally they took a third of the price out of the stock literally within a day because of the thought process that the capital reserves weren't sufficient for that bank to stay in business. Well, needless to say, 48, 72 hours later, that was not the case. But, Harry, that shows how fragile the markets can be, where, and a lot of this has to do with having just so much technology in the hands of the wrong people. And, you think about, where we were, say, 10, 15, 20 years ago, I'm not quite certain that that market would have reacted the way it did based upon the news flow. So when you take a look at where we are, certainly, we went through, corporate earnings for the quarter. They were muted at best. I guess they were okay. X the energy, which I know you like to hear this, that, energy companies showed a 27% decrease in CapEx spending because, right now they're literally, looking for ways to survive, cutting dividends, offering additional equity, via secondary offerings to bring more capital into their balance sheet. So if you take energy CapEx out, we would be up about 4% for the year or year to date. Technology had a very, very strong increase, about 17%. So having said all that, X energy, the good part of the economy looks like we're in pretty good shape here. Now, I think we look at it here, because of what's happening geographically in our area, a little bit different than what is happening throughout different parts of not only in the state of New Jersey, but also nationally as well.
We have not experienced in the metro market, Atlantic County, Cape May County, Cumberland counties, Southern Ocean County, this part of New Jersey, we have not experienced the recovery that other parts have.
No, and as evidence,
that's in a lot of areas, real estate and other work.
Well, what's interesting about real estate, particularly when you get to the West Coast, in San Francisco, for instance, you can't buy a house. Think about it. You want to sell your home, and you need to find another place to live. It typically should be a relatively easy process, but because there's such a demand on the buy side, you try to sell your house, or you go to sell your house, you'll sell your house faster than you'll be able to find a new place to live. So it's a very, very interesting phenomenon, and unfortunately, certainly not the case here, where we have a glut of supply, and it's going to take, I think, obviously, probably the better part of 5, 7, 10 years to work through that.
There is a rally to speak of, though? Some stocks that are rallying?
Year to date?
Yeah.
Absolutely. Yeah, there are parts of the market, Harry, that have done relatively well. Year to date, telecom is up over 10%. And what the investors are looking for there are big cap value plays with dividends, because dividends become very, very important when you get into the kinds of markets that we're in. Utilities up almost 7%, so the same thing holds true there. And then when you look at like consumer staples, they're up about 2%, but then everything else, all the other sectors of the S&P, materials, energy, tech, healthcare, and then financials are down year to date. So I think we are positioning ourselves here, Harry, and I'm going to go out on a limb. You asked me beginning of the year, where do you think we go? And I think the comment was, if we get to high single digit, low double digits return, it would, we'd be very, very pleased. I think we are clearing the way. As we got through all the volatility, we made those lows and hit that double bottom in February, February 11th. I think that with any sort of good news coming, I'm going to say that the markets, should have a relatively decent year, all said and done.
And I always felt that people do everything they can in power during a national election cycle, where that also should give it a boost. Although when I started to look at past years, that didn't always play how you think that it would, and maybe there's a reason for that has to do with politics and not what we do on your show, Chuck. How about we lived pretty much for a number of years on this appetite of the quantitative easing? It was just rounds of stimulus on top of rounds of stimulus. What is financial stimulus or tax reform in calendar year 2016 look like?
Well, Harry, I think because of where we are, as we talked about, as we ramp up to November, as you look at fiscal stimulus here in the U.S. or even in fact tax reform, highly unlikely that we're going to see anything happen. We're going to be in complete gridlock as we get to the end of the year, but. Once we get through the elections, there's going to be, I think, amped up, ongoing conversations about tax reform, particularly on the corporate side, because we are the highest, corporate tax rate in the world.
Yep, it's terrible.
As we get into 2017, don't be surprised if, in fact, we look to reduce the corporate tax rate for sure.
But of course, this, and I know we don't talk politics on your show, but we can certainly talk about a lesson in civics and elections. It depends who wins the election.
Well, absolutely.
I mean, if the third term of the current administration continues, then I think we're going to have cats and dogs, the legislature versus the executive branch, and then Katie bar the door, because the judiciary can dramatically change in 2017, depending on who wins the election. If the same party in power now on the executive branch wins, we will have a different Supreme Court than we've had for the past generation or two. If the opposite party that usually does win after two terms of the existing party doesn't usually get a third term, if they win, then we would probably see status quo on the high court. So there's a lot of X factors that have to play out.
Yeah, there is, and I think we kind of went out on a limb a couple of weeks ago and made a rather bold prediction as to who would be running this country. So we'll see if, in fact, that.
Well, there's actually a statistical model that has been accurate for 104 years. A professor by the name of Norpoth, and it's a big subject of my column this week all throughout Atlantic and Cape May counties at shorenewstoday.com, and it'll be delivered to your door in the next day to 3 days, depending on where you live. The delivery takes place all during the week. But that model shows a particular candidate winning 97 to 99% probable that one candidate will win, and it would be a candidate that would bring about a new party in power at the executive branch. So a lot to play out over the next 8-9 months, and we even have less than that in terms of the run-up to November 8th. So is tax reform something that just gets talked about every 4 years, or will it really happen? Because it seems to me, and I'm trying to think, George H.W. Bush, Bill Clinton twice, George W. Bush twice, Barack Obama twice. I've been here for that many presidential election cycles every 4 years since 1992 on this program, and it seems like it gets talked about every 4 years, but then in the fifth year, nobody does anything about it on purpose.
I think if you go back and look at where we are as we're telling your listeners about how wonderful the economy is, I think it's incredibly important that to get that economic stimulus, that some sort of tax reform needs to take place. And we do need to grow it 2.5%, 3.5%. I mean, you just,
we've always been able to.
You listen to your callers, and they talk about what's going on in the world and in the community. It doesn't, while statistically numbers are reported, I think all of us clearly understand this. There's a number of ways to look at stats, and is the glass. I think it goes back to, is the glass half empty or is the glass half full?
Well, the problem is if you lose your job and you don't get a new job within 30 days, and there was an old rule of thumb many, many years ago, Chuck, when we were younger, that for every $10,000 you'd want to make, you would need a month to find that. So, back many years ago, if 30,000 was your goal, it would take 90 days to find that. Well, this administration decided after 30 days, if you haven't found a job, they take you off the unemployment numbers. Right. And come on, that's so intellectually dishonest. That's why you need to go to those U reports that have the actual work participation rate, which is not good right now. But if we get back to 3% and beyond growth, that's going to fix unemployment, real employment. That's going to encourage people to give increases to their employees. Then employees will have more discretionary spending. It's going to encourage employers to hire more people. And if we get back to America the way that we typically roar out of any recession, it's going to be fine.
Yeah, Harry, and look, that's going to also put some pressure on wages, and that is very, very important because the Fed wants that to happen because they're looking for inflation. They're looking for a mechanism that they could hang their hat on, so to speak, so they can continue the process of increasing interest rates. I mean, we did the 25 basis points in December. We don't need to repeat what happened over the last 2 months, or actually from the time the Fed put that increase in. I think the Fed takes a step back and is now certainly reevaluating.
Chuck, we won't know, but could it have been worse if they didn't do that 25 basis point increase, or could it have been better? We don't really know, do we?
Harry, you don't know, but here's what you do know.
I don't know how it could have been much worse, but
it could
have been.
So the markets are up about 8% now from the low that we put in on February 11th. This is what's very, very important here. The global economy is continuing to heal.
By the way, 8% off of the low, but where are we at off of where we were?
Well, year to date, we are off anywhere from 5 to 9%, depending upon the market. The large cap, the S&P,
actually pretty resilient when you think about it.
Has fared better than the NASDAQ. Yeah. But I think this is what your listeners need to pay attention to. If you look at the rally that we've had in stocks, a lot of that has come, and the beneficiary of those rallies were cyclicals. The downtrodden, beaten up cyclical stocks, and that, Harry, that historically suggests that we're going to see improvements in the global economy. So when the cyclicals, lead us out, and the global economy, the fear was that the global economy was going to slip into recession. We're pretty certain that that's not going to be happening. We also think that the rally suggests that the U.S. dollar, which is basically near all-time highs, should have some limited upside, going into the rest of this year.
Excellent presentation as always, Chuck. Thank you.
Harry, thanks for having me.
Have a great day.
See you next week.
You know it, man. We'll reconvene Tuesday morning at 8 o'clock with the official financial advisor to the Hurley in the Morning program, now in his 26th year with us here on Hurley in the Morning. Chuck Malamut with all of your financial matters here Tuesday mornings in the 8 o'clock hour. Chuck is the managing director. He leads his group, the Malamut Group, at Morgan Stanley's Northfield office. 609-383-2010 is the phone number to reach Chuck. Tell them I sent you. The following program you've listened to is presented by Chuck, a financial advisor at Morgan Stanley. The information, views, and opinions expressed on this broadcast are those of Chuck, do not necessarily reflect those of Morgan Stanley or its affiliates. They are current as of the date of this broadcast, subject to change without notice. Neither the information provided nor any opinion expressed herein constitutes a solicitation for the purchase or sale of any security. This presentation is for informational purposes only. Morgan Stanley, Smith Barney, member SIPC. We'll be back. If you want to jump in, open forum from now until 10:06, 609-407-1450, and the phone lines have been blazing this morning. Let's have at it right now. Anything that you want to talk about. We'll come back in just a couple of minutes. 609-407-1450 phone lines are open right now.